Welcome back. Today, I'm joined by Marc Jocum from Global X, which is a large ETF provider that is on the recommended product list of both Sequoia Wealth Management and Interprac. Welcome, Marc.
Thanks, Garry.
Good to see you. The first thing I'd like to know is tell us a bit about Global X, because I know a lot of your ETFs, but I don't know that much about Global X itself. So where did you come from, and how long have you been in Australia?
Yeah, so Global X, we've recently rebranded. So we were previously known as ETF Securities up until last year. Global X was a well-recognised brand more globally around innovative, thematic and beyond ordinary ETFs. So they saw Australia as being quite a unique opportunity in terms of gaining exposure to the marketplace we have over here. So we're headquartered by Global X in the US, but we've got offices all over the world, in Latin America, Asia, Europe, and it was really about bringing this, Korean asset manager, Mirai Asset Management, who's a global powerhouse when it comes to investment management capabilities. They're managing, close to $500 billion into the Australian world. So we went through a rebranding around that, and we're starting to get a little bit more traction in terms of being recognised as a leading ETF issuer. But because we have that global research capabilities, that's really enhanced our offering over here in Australia.
Yeah, and would you consider, a lot of advisors are using ETFs now because the cost of advice is centre front on everything you read about is, what's the cost of advice and how you're trying to reduce the cost of advice. So ETFs are a terrific way to reduce the cost. So would you be considered an active ETF provider or a passive, or a bit of both?
More on the passive side.
Yep.
If you have a look at what's going on in the ETF landscape, most of the money is still going towards your low-cost passive ETFs.
Yes.
Where our capabilities come in is we've got some core offerings, like we've got our gold ETF, we've got offerings around certain countries like India or Europe, but we really wanted to offer clients an exposure to get certain thematics or certain areas, whether it be income-focused investing, commodity investing, that they don't get traditionally. You mentioned around the movement to low cost, and I think ETFs are the perfect vehicle for that. If you look at the average ETF fee, you're looking at anywhere from 20 to 30 basis points compared to the average active manager, which is at around 1 to 1.2%.
Yes.
So if this whole push into low cost investing is going to continue, and especially bring down the cost of advice, because we know that a lot of Australians are under-advised at the moment, and one of the biggest barriers to that is just around the prohibitive costs.
Yes.
So from an advisor perspective, if they can use that within their building blocks to lower their overall cost of advice, ETFs are a fantastic vehicle for that. And I think the migration is going to continue. So you mentioned around active and passive debate, and there's room for debate around having both in your portfolios.
Yes. A
A lot more active ETFs are coming to the market. I think looking over the last year of all the new ETFs, around just over half of the ETFs were active ETFs.
Yes.
And around about a third of the total number of products are active ETFs, about a fifth of the total assets are in ETFs. But the one stat that not a lot of people look at is the flows. Where is money going towards? And the majority of money is going into low-cost passive ETFs, and there's actually been outflows from active ETFs. So I believe that passive ETFs are going to continue to take more market share and are the perfect building blocks for a client's portfolio.
Yeah, I sit on the investment committee of Garry Asset Management, which is a fund manager, fund of funds. And we invest in GOLD.
Yep.
But I believe you've got two gold funds.
Do.
One's a lower cost.
Exactly.
And how are they structured? So GOLD, and what's the other one?
So the other one is GXLD.
Yep.
So that's a low-cost gold ETF that we bought out. They're both investing in the same underlying holdings of gold. So you're physically holding gold in a vault in London.
Yes.
The reason we bought out this low-cost gold ETF was just to offer another access point for people who were after a bit more of a traditional long-term buy and hold investor. But GOLD, which is our original gold product, that's been in the market for 21 years. Yes. We were the first gold ETF to actually come in the global market overall, and you just saw a lot of gold product innovation happening after that. So for a lot of advisors, and we were talking about this earlier, Garry, was for a lot of advisors or clients who still value that liquidity aspect or want to be able to be doing large volumes of trade, GOLD is still that vehicle. But from a long-term buy and hold perspective, we did want to bring out a new product to market. There's been a lot of competition, obviously, in the market. They're both the same product. They both invest in the same things. The structure is a little bit different. GOLD is a bit more of a traditional older school company type structure, whereas the newer ETF is a traditional management managed investment scheme. There's been a lot of innovation that's happened in the ETF space, but at the end of the day, the name says what's done on the tin. The tracking error is incredibly close to the gold price in Australian dollars, and we're constantly looking at ways to enhance our gold offering. You know, it's the biggest gold ETF at the market, and we're a leader in that category.
Yeah, and liquidity is paramount.
Key,
so
yeah.
you know, people trade. You know, I'm noticing, you know, when we own a clearing business, there's people trading these ETFs as if they're an index as such. But what sort of turnover is there on the GOLD?
Yeah,
so
well,
if people want to buy gold, hold it for 2 weeks or something.
Yeah, plenty of liquidity, and there's always going to be there's 2 layers of liquidity when you're looking at the ETFs. You've obviously got on the screen the secondary market liquidity, which is just buyers and sellers. But then there's also the primary market, which is where you've got these large institutions and market makers and authorized participants, which can create and redeem units. So if ever you see on screen that there may not be enough depth within a product, that doesn't necessarily reflect that the underlying is actually illiquid. Right. So these products are turning over vast amount of money every single day. Spreads are really, really tight at the moment, like sub 10 basis points, even low in the single digits. So we haven't had investors ever have an issue with getting in and out. And if they are planning on placing really large trades, you know, we're talking hundreds of millions of dollars in trades, because that's what some clients do, they can also call our capital markets team, who can actually arrange a particular block trade with these underlying market makers. But to your point, the ETF market is seeing quite a lot of volume in terms of trades. I think when I was originally looking at the number of trades, you know, like 5 years ago, it's pretty much quadrupled in terms of the value of trading that's happening. I think it's a few $100 million trading every day in ETFs. Now, that's not to say that you should be trading ETFs. You know, Jack Bogle, the founder of Vanguard, he said that he was actually against ETFs, funnily enough.
Yeah, no, I was too.
Yeah, because of the idea that you can be trading every
Correct.
single day.
Yes.
But just because they are there to trade every day doesn't mean that you should. And I'm a big believer that most of the ETFs should be a long-term investment that people buy and hold and obviously rebalance over time, but you're able to get that daily liquidity just in case you need to get out. So that's, I guess, a long way of saying that, you know, ETFs are going to continue to take more market share. They are liquid, they are traded, but that doesn't mean that they need to be traded every day.
Yeah. No, I think one of the criticisms I did have way back was that some of the ETFs were coming out were operated by very small providers, that if they had to go and then sell the underlying assets, there was no real liquidity.
Yeah, exactly.
If the buy and sell market or the secondary market. But
and that's why, to your point, it's really important for an investor to look at the underlying holdings of an ETF, and you can look at that on any ETF issuer's website by downloading the actual file of all the holdings and to see, are these instruments actually tradable? And that's where you're seeing a lot of different, you know, private assets coming into the market. Some are trying to do it in a liquid wrapper like an ETF, but it's really important that if you do want to get out, and like you said, if you do want to sell your holdings, that is that market to sell. The good thing about the ETF is a lot of it who has the physical replication of an ETF holds the underlying holdings. So if a fund were to ever close down, let's say because it doesn't reach a certain scale or doesn't reach a certain size, it doesn't become commercially viable to operate, the unit holders will still get either the holdings back or their money back if an ETF were to ever redeem.
so they just transfer into the
Exactly.
underlying
Exactly.
liquid holding.
Exactly
Yep.
right. Or your cash back.
Yep.
Yep.
Yep. And I understand you have a real dynamic ETF now, a commodities play. So the Financial Review wrote up on Monday that commodities seem to be racing up again, and there's going to be a shortage, and you know, all of the commodities, even old style commodities. So what's your commodity ETF, and how does that work?
Yeah, we've got a range of different commodity ETFs. So we were mentioning around gold, which holds obviously the precious yellow metal. We've got a silver ETF that holds silver, platinum, palladium. We also have a basket that holds all of them. But more recently, we also, a couple of years ago, introduced another ETF that tracks a lot of the softer commodities as well. And the T code for that is BCOM.
So is that like lithium and those?
Not necessarily lithium, but you're holding a range of different commodities, whether it be your agricultural commodities, your cocos, your zincs, aluminium. And you're seeing now, especially from a macroeconomic perspective, commodities are a great inflation hedge. And if inflation is going to be a little bit stickier, that's where you're seeing a lot of people putting these in these portfolios as a real ballast. There's obviously commodities that move in different in a different tune to one another. So for example, gold is seen as that defensive ballast that, when shares fall, gold rises. If you look at it from a diversification perspective, it has different drivers. Like gold is really driven a lot of the time by the US dollar and real yields. So when you see the US dollar fall and real yields fall, gold tends to do quite well. But yeah, we're a lead in the commodity space from an ETF market perspective. And it's really just about giving advisors access to what traditionally was a hard asset class to own in a very tradable wrapper. Gold is the flagship fund for us, but we've got a range of different commodities that clients can look at, especially topical quite now. And then if they are interested in looking at other types of commodities, but more in the mining space, we do have commodity mining ETFs, but these are looking at the picks and shovels of the underlying ones, like for example, uranium, or looking at things like copper, but that's more on the equity sleeve than the commodity sleeve.
Yeah. And many of that style of ETFs tend to have sort of low yield.
They do.
What?
It's just not paying anything, and that's the issue. So a lot of people might naturally gravitate towards things like gold miners instead. Yes. However, the issue with that, even though it pays a form of cash flow in the form of a yield, the issue with that is you're taking a lot of idiosyncratic risk, which is just a way of saying that you're taking company-specific risk, that even if the gold price continues to rise, maybe the actual underlying companies don't get to leverage that from an operational standpoint, and they may see margin contraction instead. So you're taking equity risk for a given commodity. And if you have a look over time, gold has outperformed the gold miners over a longer period of time. So for a pure play, that's where we're seeing a lot of clients go into these precious commodities. But if you're looking for that equity side, that's when you can look at these mining ETFs, whether it be gold mining, uranium mining, copper mining. That's where we're seeing a lot of interest, and lithium as well.
Yeah, and you do have a number of ETFs that are focused on income.
Yes, we do.
So private credit, what sort of ETFs are clients looking, that you sort of got my mother, for example, who might want to just put some of her capital into an ETF for yield and get a monthly income stream.
Yeah.
What's the sort of ETFs that suit her?
Definitely, and I think income is becoming it's becoming quite a big focus at the moment. There was a great study done by the ASX last year that asked over the next 12 months what is an investor's main reason for investing or allocating, and about a third of clients said to create and build a sustainable income stream. Yes. So very, very topical at the moment. And what's great about Global X is we've got a range of different income offerings. So your traditional income was just around investing in term deposits or cash or even property. You could have got back in the 1980s yields of around about 12 to 14% on something like that. But what we've seen in the interest rate cycle, even though we have ticked up a little bit, is there's been compression. So you're not getting those same level of yields from those instruments. Dividend investing, very, very popular. So we've got an ETF, the Global X S&P ASX 200 High Dividend ETF. The ticker code for that is ZYAU. Yep. It is a very simple product. It's currently the lowest cost high dividend strategy in Australia, charges just 0.24% per year. What I like about it though is it's not looking at companies that have historically paid high dividends. It's forward looking. It's looking at forecasts over the next 12 months around companies that are going to be paying higher dividend yields. It then also applies a momentum screen, which is great because one of the worst things you can do is invest in a dividend trap. It's got high artificial dividend yields just because the share price has fallen. Yep. So this removes that by any company that's in the bottom decile of performance detractors, it gets rid of. So that's been a really popular ETF for us.
So does that remove some of the 200 stocks that don't fit that criteria?
So what it does is it pretty much goes through the ASX 200, ranks all the companies by dividend yield, then removes those companies that are in that lower decile of performance, and then it actually blends the weighting of it based on the dividend yield and the size of the company. So you're getting a nice sort of exposure to dividend companies, but you're not taking too much sector risk because it implies sector caps and stock caps. Whereas if you were to invest in other high dividend ETFs, you may just be owning all the banks and all the miners because they have traditionally paid high yields. This becomes a bit more of a sector agnostic play, which from a diversification perspective is incredibly important. And then just on your other point around other income strategies, we've started seeing a bit more interest in fixed income. So we've got a range of US government bond ETFs, and also for clients who are interested in getting a bit more yield from the options side of things, there's some covered call ETFs as well. Okay.
Interesting. So is that a global covered calls, or is that a local
we've got
covered
US,
call?
we've got US and Australia. The Australian one's a lot more popular at the moment. We've seen around about $20 million coming into the fund. And that's traditionally because the Australian share market from a price perspective has gone relatively sideways.
Yes.
So in a sideways or down markets, covered calls tend to do quite well because you're generating that options premium, and a lot of people get a bit nervous around derivatives and option strategies.
Yeah,
but the great thing about a rules-based investing and investing in exchange-traded options that trade the ASX 200 options is you're not exposed to that same counterparty risk that you may be with other instruments, and you're getting a very vanilla and rules-based way of investing. So yeah, income investing has become incredibly topical, and we're seeing a lot more interest in our funds around that.
And is the distribution of dividends, is that monthly on all the products, or is it quarterly and half yearly?
So it depends. Yeah. It depends. So a lot of the traditional products tend to do quarterly.
Yes.
So for our ZYU, that's quarterly. For AYLD, which is that covered call one, that's also quarterly. And our US government bonds, also quarterly. We do have a couple of monthly options, and that's the US covered call products, okay. Which invest in the NASDAQ 100 and also the S&P 500 covered calls. But we are looking as well as new products that we can bring to market because a lot of people do want this monthly income or the frequency as well.
And the ones that are dictated by markets, like the ASX 200 one, is that, do you try and even the yield out and keep some in reserve, or do you have, it's volatile depending on when the dividends come in?
Yeah, so the great thing about an ETF structure is it's what's referred to as a pass-through investment, yes. Which means that all income that's earned within the ETF gets passed through to the end investor. Yep. Now, a lot of people may want that, a lot of people may want to smooth it out. So that's where you see the rise of listed investment companies who can kind of smooth that return and that distribution out. The issue with listed investment companies is a lot of the time they trade at a discount to their net tangible assets. But we are looking at, for example, our US covered call ETFs do have distribution policies that they can actually cap the level of distribution that's paid out. And that ensures that you're not getting, these volatile swings, because sometimes, the idea of monetizing volatility is that's where you get more yield. So we're looking at ways that we can smooth that return out for investors, but at the moment, that Australian one, the income does get passed out to the end investor on a quarterly basis.
Yeah, and are you considering sort of putting out some model portfolios, or do you have them already?
Yeah, so we're looking at building out our product range to be able to pretty much satisfy all the different key asset classes or the key areas that clients are looking for. Now, we obviously don't want to be offering, a supermarket where there's just everything. We are quite specialised in what we're looking at doing, but we're trying to work quite hard within our product development team, working with our advisors and our customers to work out what is that right type of offering. So whilst at the moment there's no actual structure of a model portfolio per se, we've got the building blocks ready. So, you've got the commodities, you've got the Australian equity side, we are looking more into the global share side of things, but a lot of our ETFs for our clients are more around the satellites of their portfolios. Because a lot invest in very vanilla stuff for the core, but they might want a bit more exposure to technology stocks. So we've got our FANG ETF, FANG, which invests in pretty much the Magnificent Seven stocks, driving everything. Or people who want to get exposure to cybersecurity. So we've got an ETF, BUGG, bug, for something like that. So we're kind of blending both approaches, playing in the thematic play, but also seeing, because a lot of money is going towards model portfolios because it helps drive efficiencies for a lot of advisors.
Helps the advisor.
Helps the advisor. So we're looking at ways that we can bring out low-cost core offerings as well.
Yeah. My son is making a fortune on crypto.
Yep.
He tells me every day how much money he's making. I tell him every day, be careful. So you've got a crypto ETF,
we do,
I believe.
We have two. Yeah.
So tell us about that.
Yeah, so we've got two crypto ETFs that are tracking both the price of Bitcoin and Ethereum. Now, this is a relatively...
Ethereum just popped amazing in the last week.
It did, because everyone's talking about Ethereum ETFs being approved in the US and pretty much following the same recipe that the Bitcoin ETFs did as well. So very exciting, because it's an asset class that not a lot of people are familiar with, but we've just been able to bring something out that provides that access point to Bitcoin and Ethereum. We're currently the only ETF in the Australian market that has accessibility to both spot Bitcoin and Ethereum ETFs. But I guess to your point, Gary, is that it is a volatile asset class. So whilst the price of it can rocket up to 100,000, it can also fall as much as it can as well. So we're seeing a lot of clients position this in their portfolio as almost a way to diversify their current mix by having that little sleeve, whether it's 1%, 2%, 5%, which the research has shown can improve your risk-adjusted returns, your Sharpe ratios. But you have to be willing to pretty much handle those significant drawdowns with an asset class like this. But because there's only a fixed number of supply, for example, Bitcoin, there's only 21 million Bitcoins that can never be available. There's the halving cycle that's just happened. There's a lot of tailwinds happening with that. And our Bitcoin fund, which is EBTC, has been the most popular fund in terms of performance, just driven by this risk-on sentiment. The ETFs that got approved in the US, I think there's now 10 to 20 billion that got flowed into these products in the US. So we've seen a lot more interest in our product, but it's just another way, and this is to our point of what we're trying to offer, different access points and different exposures for clients to implement in their portfolios.
Yeah. No, I'm a skeptic on the coins, but my son's turned 5,000
So
into 200,000. But
yeah.
I like the ETF concept because it's a regulated market.
Exactly.
You don't have to have your wallet and be have someone steal your ETFs out of your coins out of your wallet.
Exactly, and there's so many stories around people losing their passwords or their private key to access their cryptocurrency.
Yes.
And I'm not here to say that where the price is going today, tomorrow, or in 5 years, but people want that regulated custody. They don't want to be trading on unregulated brokers that they're unsure what's going to happen. And I think when we launched our product, which is in 2022, the whole FTX saga took place. So a lot of people might think, when you launch the product, it's you meant to launch at a good time. That was the worst possible time we could have launched the product. But now that we've built up a track record, it's a real testament to the legitimacy of ETFs being able to track asset classes like gold, like cryptocurrency, like shares. So, and I think it's going to continue. I think there's so much innovation happening in the ETF market at the moment, whether it be in different sorts of asset classes. We talked about active coming to the market, and we're constantly doing that within our product development. So I'm very bullish on the ETF industry overall.
Well, great. Well, thank you for joining us today. So you have some product managers and some people the advisors can talk to.
Definitely, yeah.
Across the country. We'll put that up on a slide. So
yeah, definitely.
The contact points. And,
contact your local BDM. If you need any information, you can jump onto our website to find any information. But across all our different products, there's definitely something for everyone to look at. So yeah, happy to provide any information. And the great thing about all ETF issuers, it's all transparent. It's all on the website. You can see how much we're managing, the fees involved. So yeah, feel free to reach out if there's any more information that you need.
Yeah, no, great. Thank you for your time.
Thanks, Garry. Appreciate it.